And on the naked put position, of course, is when we sell a put, usually hoping the stock is going to stay at or above the put strike price. Okay? And so the put expires worthless and we keep the premium and have this maximum profit. Now, if the stock falls below that price, naturally we may be forced to buy shares of stock at 160. And of course, the cost basis would be reduced by the premium. In this case, it was about $275. So the cost basis would be $157.25. Yeah, $157.25 on a stock that's trading around $159, I think it was. Okay, so Jim wants to know, what are my options for managing this position? Okay, well, let's take a look at what we call the custom spread tool. We'll go ahead and build this position, just a regular naked put on HD for our, sorry folks, May 19th. And it's the 160 put. He said originally received 275. Okay, so we thought HD was going to be above 160. Now this isn't too bad of a position. The stock's at 156.92. But again, if you're put the stock, your cost basis would be 157.25. Okay, because you'd be forced to buy shares of stock at 160. And now that the put is in the money, remember you can be forced to buy shares of stock at any time. But honestly, anyone who owns the May 19th 160 put probably won't exercise it early because they're probably waiting for earnings. And if HD earnings disappoint, now remember, you could take a significant loss. I'm not saying HD would drop down to 125, but if you see this drop, remember you're still obligated to buy shares of stock at 160. And if you don't want to own shares of stock at 160, you're going to have to roll the position or adjust it. But remember, you've got earnings coming up around 516. We just saw that. So what could you do before earnings? Well, you could just close the position. All right? If you don't want to risk assignment and be forced to buy, I don't know how many contracts you have, Jim, but if you don't want to be forced to buy shares of stock at 160, we'd look to close it at, say, 435. All right? So you take a loss of about 160 on this position per contract. Okay? Could you roll it down further out in time? Yes. But we have earnings coming up. Okay, so the problem with having the earnings coming up is we don't necessarily know which direction it's going to go. If it goes up, that's great for you. I wouldn't recommend it, but you could take the chance and say if you're bullish on earnings, you could leave the short put open next week. You'd know on 516 of them, before market on 516, if it gaps up to 161, 162, or really gaps up to 170, hey, you're back in a good position. Okay? But if it drops down to 135, 140, now you're in a worse position. You're at a 20-point loss as well. Okay? And so that's what we were looking at on this position. So we'd have to decide here what you want to do with that. Now, can you protect it with a put? Sure. I don't know if it's going to give you the profit and loss that you want because there's so much premium here. But let's say I could buy the 155 put for around 180. This is going to create for me a bull put credit spread. So we sold the original 160 at 275. I could buy the May 155 now for 180. That would still give me a net credit of 95 cents, and then the maximum loss would be 405. But remember, again, you could liquidate the short put right now for only a loss of 160 because you keep the 275 and we'd have to pay the 435 back. This puts you in a position where if it gaps below 155 because of earnings, you'd still risk 405 on the position. You free up some of the margin from the cash secured naked put because of the purchase there. Okay, and that time, if it stays above, you'd make a 23.5% return. The 95 cents against now, only the 405 you have at risk. It's really tricky with earnings because normally what I'd say is, oh, well, in 7 days from now, if you don't think the stock's going to move too much, you just let it stay below there, take assignment at 160, convert it to a covered call or a collar or maybe a married put after you take assignment. with earnings coming up, you could have a swing one way or the other. Okay, and that's what's the tricky. Could we still keep a credit by doing a ratio spread? Now you could. Remember, you took in 275 originally. So if I bought two 152 50s at, let's call it 105, that's going to put me at a cost basis of 210. So you still got a 60-cent net credit. Now you're in a ratio put spread that doesn't give you what you want. See, the max risk here is 685. That's not what you want to do. And I don't think you want to complicate this by selling other premiums, entering a bear put debit spread to try to replace the naked put spread. That's something that's done, but not when earnings are coming up, because as we just saw, you did it the other way, you could increase the loss. Same thing if you tried to do a bear put debit now to repair it. What would that look like? Well, we go to May 19th again. The bear put debit, we might sell another 160 and buy a 165. That's not going to work, but we could do something like this. So now this is more sort of a ratio back spread where you keep a loss of 160 if the stock gaps up, but you're setting yourself going into earnings for the potential for the stock to gap up and have that loss. The max profit, of course, is increased to about 340, but now your margin requirement changes a little bit because you got to cover the debit spread in addition to the naked put, but it didn't solve the problem. Right? You still have the naked put there. What you'd have to do is what we kind of saw with buying two to cover more of the downside in the case of a decline, but then you'd still have a gap, that sort of reversed V profit and loss chart if the stock fell to that 152 or even 150 strike to protect the 160. So if you're uncertain about earnings, I'd say maybe buy it back, take the loss, wait till after earnings, and then look to do another trade on HD. Honestly. Could you protect it with buying a put? Yes, we showed that. We showed what you could do with a bull put credit spread going into earnings, but again, take away some of the premium of the profit to the upside, but limit your loss to the downside. But again, right now, if you liquidate it, or maybe on Monday, you're only taking a loss of 160. So in general, most of you know, you've heard me say before that I don't take, covered calls, credit spreads, even cash secured naked puts through the earnings date. Even calendar spreads. I usually close the short call on my calendar spread before the earnings event and then look to enter it later. And you might convert it to a straddle and then reevaluate the position after the earnings comes out. And I just don't like having the chance of taking this sort of large loss to the downside or trying to find three combinations of two different spread trades to try to repair my naked put. If I'm unsure of what the stock's going to do, and this is kind of important, right? Because remember what the naked put is by itself. The naked put is an obligation to buy shares of stock at a set price, and yes, you received a premium for it. But it has the same risk. Okay, let's call it you collected 275 off of 160. Okay, so you're still taking on 97% of the risk of owning the stock outright. You wanted it to stay above 160. That necessarily hasn't happened. I can't say it's not going to happen. I'm just going to say it hasn't happened. So if you're in a position with earnings coming up, you don't know what to do. You don't know what the earnings on HD are going to be. And you're not sure if you want to own the stock or take the loss of the risk, I should say, of having it drop down to 140, 135, or 130. I would consider just closing this position. Take a loss of 160 per contract, and then evaluate after earnings to see if it's still a position you think is good for writing cash secured naked puts that are out of the money and hoping they'll expire worthless. All right. It's a coin toss, I mean, it's a flip of the coin here what's going to happen. I know HD is a strong stock. I know they've probably geared up with their earnings because the spring planting, I should say, and preparations for summer backyards and so forth have started, so we're hoping for a good quarter there. But at the same time, you just don't know. They could beat earnings. They could beat revenues. And their projection for the next quarter could be abysmal, and the stock could drop 15%. Covered call, naked put is not a position that you necessarily want to be in heading into earnings in that fashion. It's just like owning the stock without an insurance on it, without a near-term put to protect it in case of earnings, or even a far-out put as a married put position for long-term growth, okay? So that's what we're looking at. All right, let's see here. A couple more questions coming in. All right, I was scrolling through. Oh, Sam was saying that HT normally drops, then will come back up. He made a comment of looking at maybe a 5-point movement based on the 29% volatility. So maybe that bull put spread would not be a bad idea. But again, that's not my direct advice. Sam's offering his opinion on how he evaluates volatility as well in that range also. Okay, Becky says, can you take advantage of earnings, get in a position of any option with defined risk? Well, that's what a straddle was. And what I mean by that, Becky, is let's say we know HD has earnings coming up on the 16th. Okay, so a long straddle, I might buy the 19th. Sam might go out to June 2nd because he said he might buy 3 weeks out and then trade, but that's not what he's really doing because in that case the earnings would have to be at the 19th. But a short-term straddle position might go at the money here. They're about the same price. So, Becky, if I bought a 157.50 call and a 157.50 put, and I'll just use the natural ask price here, well, I pay $234 for the call and $292 for the put. My cost basis is $526. Okay, so if I buy one contract, I'm going to pay $526. If HD stays right at 157.50, what do I know? Well, I know that both options in a couple days on the 19th are essentially going to go to zero if it stays right at 157.50. So my maximum risk is dialed in. What's the problem? The problem is this represents 100% of whatever you enter in the trade. So if you did 3 contracts that were $1,570, for example, or so, $1,578, you could lose $1,578 on the straddle. It could be a 100% loss. Very unlikely that it's a 100% loss, but if it just stays here, or even if it just moves down a point, let's say if it goes down to 155, what's going to happen? All right. Well, at 155 on the 16th, with only 3 days to expiration, your put is going to go to a value of about 250, so you've got a 40-cent loss, and your call is going to go to a value of 0. So, okay, you don't have a 100% loss on the position at that point, but you're still going to have 50% loss on it of whatever you invested. Okay, now can you do it more cheaply? Yes. You could do a strangle. Okay, I want you to keep in mind here, look at the static break-evens. It's about a 10-point break-even, which makes sense because we're paying 5 points in the position. So to really get a profit, I'd need the stock to be down 152.24 or up to 162.76. Okay, so, you know, Sam had mentioned that expect a 5-point movement. Well, that just doesn't do it. It almost puts you back to break even. 5 points up, be about 76 under. 5 points down, you know, it'd be about, you'd be about 24 cents profitable. Okay. Can you do it more cheaply instead of risking 526? Yeah, you can, but you need a wider move. Okay, so if I want it to be more cheap, I could buy the 150 put for 57 cents and the 162.5 for, let's say, 60, or both for about 60 cents. Okay, so we're going to buy one of the out-of-the-money put and one of the out-of-the-money call, both for 60 cents. So I've only entered $1.20 into my risk instead of 526. Where's the problem? Well, the profit doesn't kick in until it drops below 150 or moves above 162. So now we're back to the 7-point movement in either direction, you know, in that case. So you pay less to get in the position, but your upper and lower break even go up by about another 5 points, 2.5 points on each side, right? So now you're 15 points in between, and each one's about 8 points from where you are. Yeah, 7.5 to 8 points, okay? So it's 100% of what you invest, but if I only did 2 contracts of this straddle or strangle, for this strangle, when you use different strike prices, that'd be a max risk of $240 if I did 2 contracts, $240 in my account. But again, you'd need the stock to really gap down or really gap up to realize a profit. We're looking at about 180 here and 130 here. That's to get a big profit. That's a 50-point range, 25 points in either direction. Okay, so it's kind of tough for that. So there it is. Now, can you use a protective put position? Yeah, but you have to put up the money to do it. You can create a synthetic straddle with a married put. So if I owned this stock here at 156, if I was opening this as a married put today, then I'd probably go out at least to November, maybe September, but I'd probably go to November. I'd probably go with the 165 put for a radioactive trade. Okay, go slightly in the money. I'm looking at about a cost of $13.50 for my put option. Yeah, there's a risk. Now, I'm sorry, folks. Let me go lower. Now, this isn't one I would trade only because it's outside of the range of what it's outside of my personal trading range of the stocks that I buy for this strategy. Okay, so I usually don't ever go above about $90, and very rarely am I in that range. So 160 is sort of out of the ballpark for me. I'm going to put this at 1045 for the 160 put. So as a married put combination, I'd have a risk of 4.4%. But what do I know? I know I have earnings coming up within the next 10, 15 days. So what I could do now is maybe go in cheap, go into June, and let's say buy a 150 put. Now it's going to add to my cost basis, of course. It's like a strangle. But one of the puts I'm using to protect the stock position long term. The other one I'm just using as a stopgap in case the stock does fall to 135 or 140 or 143, so I can use that and the gain in the long put to counter down. But remember, look here, even in the worst case scenario at near June expiration, if the stock stays at 150, I'm only losing $500 or 3%. Okay, but I have to put up the capital in order to get that single digit risk. Otherwise, you're looking at a straddle or strangle where you're risking 100% of what you invested in the position. That's how most investors take up on earnings, is looking at the long straddle, buying a straddle, or buying a strangle. And again, I don't know, I think I've had more luck with the straddles where they're at the same strike price and at the money as opposed to the strangles, because you need that wider movement even though you have a lower cost basis. Sam's approach, let's say there's earnings coming out in 2 weeks, of buying a 3-week out strangle and selling a 1-week out call or put against it to lower the cost of that further out strangle, might be a good approach, because you're already starting with a lower cost basis than the straddle where they're at the same strike. But again, it's sort of what you're willing to risk and what you're willing to pay. But remember, you're talking about needing, in almost all cases of a straddle or strangle, needing a 7 to 8% movement on the position. Okay, if you don't get that, you're going to have an 80% loss on whatever you put into the position. Becky, yes. She says, whatever strategy, do you want the stock to move outside of the pink lines? Yeah, this is a bad example here because this is a married put I was looking at where I had a November put, and I bought this cheap June put as a way to maybe take advantage of the earnings coming up. But these pink lines, yeah, they're reflecting the upper and lower break even, where I need the stock to be trading to realize a profit. But since I'm using a shorter term option in combination with a longer, this is just at June expiration. This isn't for the whole position to November. This is just at June expiration using the Black-Scholes pricing model to calculate what our November put would be worth. Okay, so let's go to a standard straddle. It's probably easier to see what we were looking at before on Home Depot. 157.5 call, 157.5 put. I believe I just used the natural ask prices for these two options. So if I just did one contract of each, I'd have to put up $526, and I'm risking $526. Again, if the stock doesn't move, or it only moves up 60 cents and is trading right at 157.50 after the earnings and stays there through expiration, well, both these options are going to go to zero, and I'm going to lose that entire $526. as probably the most unlikely scenario with this outcome. It's going to have some movement, but as Sam mentions, it could drop and go down to, let's say, 151 on the 16th, and then move up 1.5 points on the 17th, and then the 18th, we might see it back at 156, 157 on the 19th of expiration. But again, to your point, Becky, I'm going to keep the math simple. Not to say that you need me to do that, but I'm just going to put in a cost of, $3 here and $2.50 here. So instead of $5.26, we're going to have a cost basis of $5.50. Okay? Now the break-evens come to nice round natural numbers. Why? Because it needs that movement. So we're purchasing the 157.5 call and put. What happens if the stock falls to 152? My 157.5 call would expire worthless. My 157.5 put would have $5.50 of intrinsic value. Probably only 2 days left to expiration, so I would only have probably 10 cents or 5 cents of time premium. So there's my break even. The call goes to zero. My put is worth $5.50 of intrinsic value. That's my lower break even. I would need the stock to be trading below 152 to profit on the downside. 163. What happens there? Stock gaps up to 163. My 157.5 put expires worthless because it's now out of the money. My 157.5 call has a intrinsic value of $5.50. Again, I'm at break even. Anything above that would be a profit. Time value is not much of a factor here because the earnings come out on the 16th. That's where we're basing our movement on, and we're holding the 19th. So there's only 2 days left to expiration after the event. So this is your upper and lower break even. And in this case, yes, you would need the stock to be trading below the pink line or above the pink line in order to make a profit. Okay? I'm not going to get into the short straddle really, but if you sold both of them, it would be different. You'd want the stock to stay between the two to make a profit. That's not something you do around earnings, so I'm not even going to bring it up. Okay? All right. Now, let's see here. Okay. All right. Jonathan I talked to earlier today, and Jonathan I believe also had a coaching session with Ernie. I wasn't sure if Jonathan, if you and Ernie were going to cover this. Jonathan is in a bear call spread on Domino's Pizza where he sold the 190 and bought the 200 for next week's expiration, May 19th, standard expiration. Bear call credit spread, of course, is where I'm going to sell, sell a call and buy a call at a higher strike price, and I want the stock to stay below both strike prices so that both calls expire worthless and we keep the net premium. Of course, we see right now the stock's trading between those two. Now we've got a debit of 125, so let me say we just sold this one at 250. And we bought the 200 at 125. Those don't need to be the accurate prices because we have a net credit of 125. Full risk is 875 because we're in a 10-point spread. Return is 14.3. Okay, now it's a bearish spread, but the stock has moved against him, meaning that it's moved up in price above the short call strike price. 720. Okay, not a concern there with earnings. I didn't know if they were coming up next week too. Sorry, I'm just sighing here a little bit, Jonathan. It has nothing to do with your position. I remember 4 or 5 years ago, I was trading Domino's, I think, when it was at $24 per share. I can't believe I look at it now and see it at 195. Whatever. It is what it is. You know, I remember when Priceline was at, I think, $300, and I thought it was way too expensive of a stock. It's at $17.80 now, $16.80, I don't know. Anyway, here's what we're to talk about. Spreads going against us. Jonathan has an obligation to deliver shares of stock at this price at 190, but he owns the right to buy them at 200. Okay. Now, in addition to this, in the background, Jonathan, you also own the shares of stock. So this is more like a covered call combination. I think you said your cost basis on the stock was 183. That changes the whole dynamic of this. in the sense that you might not have to do anything with this, just close it out, keep the stock, and move on. But let's look at this just as a bear call. One of the things that is considered to do in a bear call credit spread when the stock goes against you is what I call the pendulum adjustment. And what it means is instead of closing this whole position out and just rolling further out in time to try to roll for a credit on the position and give yourself more time and a higher strike price when you've already been wrong on the direction of the stock, with only 7 to 10 days left, it might be possible to simply swing the long call down to another strike range, let's say, or we'd probably go to 180 here. So we're going to swing that down to try and create a bull call debit spread now that the stock's trading above the strike. And so with just one simple roll, we've swung the long call out in a sort of pendulum movement and turned the bear call into a bull call debit with one movement. In order for that to happen, the net debit that you're going to pay to make this adjustment has to be the debit, has to be less than the difference in strike prices plus the initial credit, okay? Or minus the initial credit, okay? So in this case, what are we looking at? Well, we tried to evaluate earlier this simple roll. What am I going to do? I'm going to sell to close the 200 call for May, and we're going to get nothing back. We're going to get 35 cents back selling to close this call. Okay, but that's not what's important. What's important is what we end up paying for the 180. We've got a bid of $14.80 to $16.20. It's a bid-ask spread of $1.40. So 70 cents between. Midpoint would be $15.50. Okay, so where am I at here? My new net debit that I'm paying for this roll is going to be $15.15. Okay, and I said, Jonathan, I'd mentioned earlier, this is why I think you needed an original net credit of closer to $5. Because now, oops, sorry, I didn't add that in right. Now, the difference in strike price to your lower call, to the call that you sold, is 10 points. That's what you can potentially get back on the debit spread. So now if the stock stays above 190, you can buy shares of stock at 180, sell them at 190, and you get 10 points back. And you originally received a credit of 125. So that puts you at 1125. So this debit of 1515 that we just paid here has to be less than this value, which it is not. Okay, so this isn't going to work. This is going to lock you into a loss at this point. Well, I said via my email, this is going to lock you into a loss of about 390. So even if the stock stayed above there, take that risk. And of course, the downside is why this wouldn't work for this pendulum adjustment is you've more than tripled the risk. Well, no, I'm sorry, not tripled it, but you've also increased the risk up to 1390. So if the stock does fall, as you originally expected with your original position in the next 7 days, goes back below 180, you'd actually lose 1390 instead of having a profit on the position. Okay, so what are some of the other ways that you may adjust the position? Well, at this point, it might not be a bad idea to just consider closing the position out. Okay, I thought about rolling up to the 195, but that doesn't work for us either, even if the stock fell below it. It would cost you too much to buy to close the 190. You're only getting $2 or so back for selling the 195. So, you know, you get $325, but you're paying $5 out. That would also lock you into a loss. All right, what do I mean? Let's just take a look. I buy to close the 190 now at about 560 midpoint. Okay. I sell to open the 195, let's call it for $2. Okay, now this is just usually a defensive maneuver. This is why I usually keep 2 strikes between my spreads. But there you go. See, now it locks you into a loss of $235 if the stock goes to 195. You increase your risk up to $735. Okay. So, again, going back to the bear call, the pendulum adjustment I talk about as a way that usually works when you're in between strike prices is not working here. going up to the next highest strike. Doesn't work here. We're too close to expiration, and Domino's Pizza doesn't have any events coming up where the volatility has increased this, so they're both, all the options we're playing with are right at about intrinsic value. All we're doing is swapping money for money. We're not getting any time value benefit. So depending on what your goal is for this position and your expectations are, you could roll out to June to try to mitigate the loss, but I think this loss is going to be big enough where you're going to be locked into it. What do I mean? We've got a 10-point spread. Let's close out the May spread entirely. So I'm going to buy to close this again at 560, sell to close this at 35. Now I'm going to run this. It's going to look a little silly, but I'm going to run it anyway. Okay, so what does this mean? We're down $400. Right, this is a loss of $400 right now, but remember your maximum loss was about $875. So you're only taking a 50% loss in the spread if you close it out now. Okay. Now, taking in that $4 loss, what does that mean? It means we have to make that up somewhere. Can we do that in June? Can we get a 5-point spread for June? Well, not really. And I looked at the numbers earlier after I got your email. The 200 to 210 is only going to be a $2 credit. But now you still need the stock to stay below 200 in the next 35 days, excuse me. You say, oh, well, I can get close to that 4 if I do the 195 and the 210. And you're right. That would give you about a $4 credit. But now you're still in the same situation where you need the stock to pull back and essentially be below 195 sometime in the next 37 days. And what has happened? Well, the stock has already, well, the max credit would be 390 because I didn't use midpoint. I just used naturals. So this could get you back. But you've moved from the 190 to the 195, but you were already wrong on the direction of this position. You know, it moved against you. So if the trend continues on this position, on DPZ going forward, you may end up taking a loss up as high as $1,110 as opposed to $875. But again, you're taking a $400 loss on this spread if you liquidate it now. You can get close to a $400 credit for a wash here by rolling out to June with the 195 strike, which you're already slightly in the money on. Okay? Can we do it with a put instead? Stock's been bullish. It's been moving up. Do you think it's still bullish? We look out to June. And let's say we do, again, you'd have to be right at the money. You'd have to do the 195, maybe, oh, geez. You'd have to do the 195, 180 for a 50-point spread or 175 to get the 4 points. So it's kind of a disparity there where these calls, the 10-point away calls actually look cheaper. Yeah. Well, not too much. I guess that's about right. But in any case, you know, doing the 195, the only way to get $4 is to go close to the 175. Now you're looking at a 20-point spread. Okay, so you're going to have more margin requirement on the position. Now, let's go back one. And if you're just thinking about this as a bear call spread, I think those two I just mentioned might be your best adjustments because we saw we can't do a pendulum. There's no way you're going to be able to repair it with 7 days left because these options are, look at them, they're going to zero. DPZ is low volatility. Only the at the money is offering any premium, and that's already gotten you into trouble. Okay, we can't roll up to the 195 for your bear call to repair it. We can't roll down. We can't do a pendulum. So we're looking to roll out. Now I don't want to go to September because that's 4 months away. It's a long time, and anything can happen between now and 4 months from now managing the spread position. So that's why I'm looking at the June shorter term. Now, another opportunity? I don't know what you think about this. You might want to close the spread now and take the $400 loss per contract and then wait till after May expiration. Why? There's no earnings coming up. There's no big event. No, but the Monday following May expiration, you'll have a July series available. You may even have a July and an August series available. So that'll give you more opportunities rather than going 126 days out. Maybe you can find a repair 70 days out, 65 days out or so, 90 days out to August. Okay, maybe. But right now, June is the only one you're looking at if you're looking to roll. That's why my focus is there. I don't like going to September because it's 4 months away and a lot can happen between now and 4 months. I'd prefer to keep it shorter term. That also means it's easier to adjust in the shorter term, in my opinion. Okay. So I would say that you want to maybe consider closing it and waiting, okay, for the next cycle to come out after May expiration next week to see what new series comes out, what new premiums are there. You could close and roll to the OTM June bear call. One of them would cut your risk in half with a credit of about $2 to your $4 loss. That was looking at the 200 and the 210. If you use the 195, then you were looking at maybe 400 to break even, but again, you're already slightly in the money again, just not as much as the 190. And then, of course, you could close and do the opposite, do the bull put, because the stock's been moving up, so close and do the opposite and do the bull put. But again, to get the 4 points, you'd have to be right at the money and take a 20-point spread, which I'm not sure matches your goals at this time. All right. Now, all of that being said, I don't know how many contracts you have, Jonathan. We didn't talk about that, but let's consider the grand picture. If I'm not mistaken, from your initial email, you had 2 positions that you were interested in evaluating. One was this bear call spread at 190 to 200 where you took in a 125 credit. We know where that stands. We just reviewed it. Nope, 250. Extra 6. There we go. And you bought one at 125. Okay, so there's our bear call spread. We saw we could close out for loss about half of what it is at expiration, and that would only occur if it keeps going up and goes above 200. Okay. Now, I don't know how many contracts you have, but what I do know is this. Let's say I put in 3 contracts of each. I think you told me in your email that you own 300 shares of stock at 183.50. I can't remember the exact number. Now, this is a whole different trade if you add them in combination. So right now, you're not looking too bad. Why? Because if you do close the position and take the $400 loss on your bear call spread, your stock is still up 12 points from where you got in. So does that increase the cost basis of the stock? Yes, but it's still at a lower cost basis than where we're at right now. Okay, so you've got close to $12 from 183. Closing the spread is going to cost you $400. Okay, so you're still up $800 on this position. You know, cost basis essentially of, we could put that around 187 or so, 186. Oh, I'm sorry, yeah, 186, okay. So with that in mind, you're still in a reasonable position. What you could do is just close out the spread, look at your stock as a different position with now an increased cost basis, maybe up to 186 or whatever it comes out to be for those contracts, and then evaluate the position going forward. Do I want to just maybe sell the 200 call against this? With the stock at 186, my cost base is increasing to 187 roughly, and still having an $8 gain in the underlying security. I know it's not a lot because we're at a $180 stock, but you know, you have a new cost base about 187. Well, maybe you could buy a 200 strike put for November to have a controlled risk of only 4% and then still sell the 200 or 210 call for June against the position. So rather than looking at individually that the bear call spread is losing and you've got a stock that's gaining and consider them as 2 separate positions, maybe consider it one position as a whole, and if you close this out to take the $400 loss, that puts your cost basis up to 187. You're still profitable $8.28 on the position, or however that math works out based on your cost basis, okay? So you're still looking fine. But as far as a repair on a straight credit spread position goes, I went through all the examples. I would have the 5 or 6 examples I go through in my managing a bear call credit or bull put credit spread presentation, and I didn't see one. I would have told you if I did. But yeah, the pendulum didn't work. Rolling out to June as a bear call worked, but remember this stock had been moving against you. Rolling and turning it into a bull put credit spread would work, but only at a 20-point spread, and that didn't look feasible based on how much margin you want to put into the position. So as a whole, though, from what you told me in your email, I think you're still, okay, I'm sorry, it was a different cost basis, my apologies, 186.39. So you had 3 contracts, long 300 at 186.39. Okay, so 186.39, you're going to take a $400 loss by liquidating these two positions right now. We already saw that. The 125 taken in and about the the 525 or so debit to close that spread that's between your two strike prices of 525. So you're going to take a loss of 400. Your cost basis on Domino's now, 300 shares, as a total position would go up to 190.39. You're still at a profit of just under $5. You could sell the 200 call for June against those 300 shares, even May for 30 cents now, and sell the June later, but you still have some profit that we could use to buy a put. In my email, and I'm sure what Ernie might have talked to you earlier today during your coaching session, you use the married put tool. The insurance tool under married puts. All right? And, oops, sorry folks. What this tool does, it just allows me, it allows me to put in my cost basis. I'm going to go back to radioactive trading. I want to remember what my closing cost was on Domino's now. It's money got away. Sorry, knock on wood. New cost basis of 190.39, Jonathan. After rolling your bear call spread, costing you about $400, so we're increasing your cost on the shares. And in my email, I said that now normally I don't know all of the expirations, but I do know that I typically want to at least go out 150 days. Okay? So September was 126. I'm going to go to December if I want to convert this to a radioactive trade. You could use September. Let's just take a look at it. Okay, something's, am I in the right tool here? Married put insurance. That should still, I don't know what's going on here. I think I hit something wrong. Oh, that's silly. Let me do it this way. It's having, I saw this earlier. I apologize, folks. There we go. I don't know what that was. All right, so we've got Septembers and Decembers. Okay, let me go to September. Man, it really didn't like that for some reason. I don't know what that was about, folks. I apologize. All right, now, because of closing the position, you've got a gain now of only 2.6%, 489, close to 5 points. Now, you could go to the 240 put for September at 45.55. Your new cost basis would be 235.54, and you're guaranteed to get 240 back, so you've got a locked-in profit of 1.9%. But to be honest, these top three results don't make sense to me. Why is that? Well, because I know the stock may continue up, but I'm not really expecting it to go, and I'm focused on the next 20 to 30 days. I'll show you why in a moment. I'm not really thinking the stock's going to hit 230 or 240 in the next 20 to 30 days. My target would probably be closer to here. Now, it doesn't bulletproof the position, but think about this. September's 126 days out. For $13.05 per share, so about $3,900 to buy 3 contracts, you could have a risk of only 1.7% on your shares of Domino's going through December and still have the ability, after taking into account the $400 loss on the bear spread, still be able to generate profit against it. Okay, so let's take a look. So now I take a target price where I think the stock might be trading. So here's my 1.9% risk, 379. Now this is only for 100 shares, so if you want to see the full math on it, I just use percentages mostly, but let's go ahead and take a look. $1,100 risk, 1.9% off a $61,000 investment, okay, as well. Sam says demand on pizza is high in the summer. Yeah, but it's a demand in all 7 different quick delivery places. Pizza Hut, Papa John's, Domino's Pizza, Pat's Pizzerias, CC's, everywhere else. So it's a higher competition between the 3. So Domino's usually outperforms them. You're absolutely right. It's a bigger market over the summer. But this does take us through the next earnings in July with only a risk of 1.9%. Okay? So now, we factored in the $400 loss on your May bear call credit spread. We know that affected the cost basis to 190.39. Okay, you're still profitable by 5 points. We could protect the position for 126 days. cost of $3,900, 40.20, I'm sorry, over $3,900, 40.20, but guaranteeing that we don't lose more than 1.9%. And at the same time, I could look to June now and say, well, what about that 200, 210 bear call spread? Sell 3, buy 3. So I'm going to, let's say we get 250, that's at midpoint, and let's say we pay 50. All right. $600 worth in. Now you still got an infinite upside. You've still got, you still got a chance here if the stock's right at 200 for about a $2,000 profit on a $60,000 investment. If it goes above that to 210, you give back about half of that, but you're still profitable. And if it continues to move up in price, you've got infinite upside. And you only have a 0.9% risk on the entire investment, not only through June, but all the way through to September. So what happens if this spread expires worthless? Okay, let's say the stock stays below 200 by June, 35 days away. Both calls expire, take them out of the equation, and we're going to put your cost basis back to $2 below at 188.39. It's June expiration, calls expire, there's your risk of 0.9%. Let's say the July series is available at that time. The stock's still trading around 194 or 193. I don't know how fast Domino's is moving. But then for July, you do a 200 to 210. But let's say this time, you only collect $1.70. So we get 260 here. I'm sorry, not 270, 170. Sorry. I'm sorry about that. Yeah. So we get a 170 premium here, 260 by 90. Now you've got a bulletproof position through July expiration. Remember, we're going future here, but that means you'd have no risk likely going into July earnings. And, of course, you still have protection after that for August through to September with no chance of loss on the position. $2,700 profit at 200 at July. $1,500 profit at 210, infinite profit beyond that, no chance for a loss. That is the rosy optimistic view on that position. But when you combine the two together, rather than looking at it as you're taking a 50% loss on the bear call spread, in order to take that 50% loss on your separate bear call spread, which was $400, you made $800 on the stock. All right, so you're still profitable on the position. It can still be managed effectively. Use the insurance tool to see which put best suits your expectation and the controlled risk that you want. You can go shorter term. You can go longer term. Like I said, I might go to December where the risk would be higher at the 200. I'm risking 3.3% instead of 1.9. But now I've got 217 days, another 3 months of insurance on this position. And the most I can lose is 3.3% in the worst case scenario. I still have the ability to do other positions against it as well. Okay, so where am I going with this? I know it was a lot of numbers I just threw at everyone. I understand that. But what we did is I showed you the ways that I would look to analyze a bear call credit spread that is between the strike prices. First, I tried the pendulum adjustment. Then I look for the other opportunities. Sam says, Sam had mentioned a bull put credit spread you could do now for about 10 cents for May expiration. It would help it a little bit depending on how much you wanted to put into the position as well. But anyway, what I showed is taking that bear call spread that you mentioned, Jonathan, on its own, and how I would analyze a bear call spread on the position. And what I would look for is the first thing. If it's between the strikes, I look for that pendulum adjustment right away. Okay, if not, then I say, if it's just at the short call strike price or just a little bit below it, I look to see about rolling the spread out in time, which is not one of my favorite things to do. I look at changing it to a bullish spread or to a bull call debit or a bull put credit spread because I was wrong on the direction of the stock and I don't want to be wrong again for the next month as well, trading a bearish position on a bullish stock. Then I would look for opportunities to maybe buy to close the short call and leave the long open. I didn't talk about that one, buying to close the 190 and leaving the 200 open, because it's already between the strikes. you're going to pay so much money to close that short call, and you only have 7 days for the stock to move up to counter the original loss on the spread plus the buyback cost of the short call. And if your long call goes to zero, you've taken a bigger loss now than you would have on the bear call itself. So I don't think that's a viable idea. I looked at rolling it up 1 strike. That didn't work out. It did work out to lessen the loss, but you still probably locked yourself into a loss. And those are the 7 approaches I talk about here in our archived webinar, Managing Your Bear Call Spread. And further down, there's one on Managing Your Bull Put Spreads. And that's our public webinars page, powerup.com/webinars.asp. You can access at any time. But those are the management techniques I look for right off the bat. Sam mentioned a couple of other opportunities. I'm not a fan of trying to convert a near-term bear spread or bull spread that expires in 3 to 5 days to an elaborate butterfly or condor spread to try to repair it in a 7-day period. It just adds too much complexity and it adds to the risk. Might not be worth it long term, especially if the stock swings. Think about it. If Domino's, and that, I'm sorry, I'll talk about that in a second, but if Domino's Pizza swings back down and you tried to repair your bear spread with a bull spread and the stock falls, you're going to lose on the bull spread where you would have just won on the bear spread had you left it alone. And that's another thing to consider. Jonathan, is that your broker right now is probably seeing this as an in-the-money call on Domino's Pizza. Now, you may be able to leave it open next week, and if the stock pulls back, you might be able to pay less to buy back that 190 call. But remember, I don't know if this is in the same account. I'm assuming it is. But if you get assigned early on that short call, which I don't think dividends, were dividends coming up? I don't think so. But when you're in the money on this short call, next dividend is June 13th. Okay, so it's still time. But when you're in the money on the short call, you can be assigned at any time. It's possible that if you got assigned early, your broker definitely wouldn't use the 200 call to cover this obligation. Your stock would just be assigned. You'd lose those 300 shares of Domino's Pizza, get assigned at 190. Now you'd still have a gain, and you'd have a 200 call floating out there in the ether that expires in 5 days. But remember, you can be assigned at any time on this position. So if you want to avoid that, you got to consider closing that 190 call that we're in right now and moving it up or moving it out in time. And again, you could roll right now to the June as we saw. You could buy it back, take a look at that September put to lock in a 3 or 1.9% risk, and then do another income method, number 6, 10-point spread, which is really just a covered call with an extra call is how your broker would see it. Get some more premium, and we took the risk down to 1.9%. You could even close the May position now, absorb the loss of 400, buy the September put to protect you, or the December, whichever you decided was best for you, monetarily, and how long you're planning on holding the stock, and then wait a week. And come May 22nd, see what's available in the July series or the August series, or go with the June, depending on where the stock is and what's happened. Okay? So I don't necessarily think it's a bad thing because you own the stock. I'm sorry, it's not a bad thing because you own the stock. Because your gain on the stock has more than outpaced the loss you're going to take on this spread. You can still manage it effectively, and I think we've shown that as well. Okay? Oh, sorry, Jonathan, you'd said, great, extremely thorough. How do I access the replay of the webinar? I want to go through the income method 6 mechanics again. Well, that webinar I just showed you, the free webinar, on managing a bear call spread. This is just what I was talking about a bear call spread by itself. Okay, that's here. This webinar is going to was recorded. I think I started the recording after our brief discussion on straddles in the beginning, I think. But anyway, I did record this presentation. I have to convert it. It'll probably be posted tomorrow, and I'll send everyone an email when it's going to be posted. As always, it's going to be posted here with our other webinars. So the one from 5.7 that I posted on 5.9, using power options for trade management, technical criteria backtesting, and more. That was last Friday's discussion. This Friday's will be here. So you just go to powerup.com/webinars.asp. It's a free page. And of course, just log on to your Power Options account. And under the main home tab, click on free webinars. The Friday discussions are always in the requested topics category. You know what? I know that for a fact this one is going to be posted sometime tomorrow. How do I know that? because I'm going to convert it after we're done. I have to check a couple more emails after we finish the webinar. And we're going to be under rain all day tomorrow for a nor'easter here in the mid-Atlantic states. So I am going to be in the house, and I'll likely come down here at one point or another, upload the video to YouTube, and then put it on here as well. Likely when my 3-year-old daughter is down here trying to play on the computer or type as well. So we'll get that handled and we'll get that done. But it'll be here in the requested topics field, Jonathan. That's where you see it as well. All right. Becky says, which way is better to find out the average move of the underlying, delta or moving average? Combination of maybe moving average and volatility. That's what Sam was mentioning earlier, is that, a stock with a lower volatility is likely not to move that much. You're talking about an at-the-money strike for a straddle that we were looking at, Becky. You've got a 50-50 probability. Now, we know with earnings there's going to be a swing. But if you only have a 10% volatility on a certain price stock, as Sam mentioned, you're taking the delta, which can also be related to probability, in combination with the implied volatility is what I'm saying. Okay, so when I bought that further out strangle that we looked at earlier, you needed a much wider movement. You had a lower expectancy of profit, but you had a lower risk. The at-the-money straddle, Sam had mentioned that, if something would have had a 10% volatility there, you might have only expected a $2.50 move based on the volatility. And at 20% volatility, I think it was 29% actually, he was thinking more of a 5 to 550 move from the at-the-money strike. Okay, but was that enough to get a profit? A very small one on the straddle. We need a surprise with the straddle. You need to say, oh, well, if the standard equations that are out there that some companies use for delta and implied volatility of movement of the stock equals 5 points, and my straddle cost me 510, what I'm betting on is a surprise that they really messed up and had poor earnings, or they did something really good and had unexpectedly high earnings, so I get that 8, 10 to 12% movement. I know that the expectation might be 5%, but I'm looking for a surprise. Okay, and that's what we're looking at for that kind of strategy there. So it's a combination of multiple things, more along the lines, I'd say, of delta combined with the volatility of the underlying, not necessarily the moving average. Especially when you're going to earnings, you can't consider that just because a stock's been bullish going to earnings, it's going to have a good report. It might not. It might surprise. I think Snapchat was up in price. Let's take a look. Was up in price before their earnings. I know Macy's really wasn't, but let's see here. Let's go to big charts here for Snap. Well, you could say that. I mean, there's their first earnings, so it's not really fair. But yeah, here's their IPO. Release and do. Okay, they're kind of hanging out here. They go down, but look, yeah, they were moving up towards earnings and then plummeted. But yeah, this isn't every stock. Just because the stock's up before earnings doesn't mean it's going to crash. It's just, this is sort of a, I don't know, not a good money maker potentially. Yeah, it's a 1914, 1930, Sam. That's right. Sam was pointing out about Netflix as well. NFLX. So after the earnings pop, this had been sort of stagnating and condensing. And I guess you could say it moved down before earnings, but really the 3 days before it was moving up, and then there you go. It's up at 160 after the jump, So that's well. It's like when Facebook came out with earnings for the first time, yeah. And what's the other one I always think of and forget? Twitter as well. So those are some of the things just to consider there, that it's not necessarily just a combination of the trend before the earnings when you're looking at a straddle. It's a combination more of the trend and the volatility, not the trend and the delta, more of the trend and the volatility. I could see two stocks trading at $40. One's got a volatility of 40%, one's got a volatility of 10%, and I find a third one that's got a volatility of 80%. Well, I could say that the one with the 80% is likely to move more. But at the same time, any options I buy on that are going to be 3 times as expensive as the volatility at 40% and probably 10 times as expensive as the ones with the volatility at 10%. It's a trade-off. It really is. All right. Well, ladies and gentlemen, I don't see any more questions there. We had some great conversation today on managing naked puts, for example. We talked about straddles, strangles. We talked about management techniques of other positions, and then of course we talked about, again, the difference between the straddles and the strangles and what to look for in that scenario. We might want to consider, I should say, in those scenarios as well. All right, so remember, those of you that are just joining us for the first or second time, if you haven't done so yet, go to poweropt.com. All you have to do is put in your first name, last name, and email address, and you'll get full access to the suite of tools for 14 days. You don't need any credit card information or anything like that. And anyone who's on a trial of Power Options can schedule one of those coaching sessions at any time, or send us an email or give us a call with any questions. After the 14 days, we do have different levels of service. We do have an end-of-day service, which is only $40 per month. So if you're just practicing and testing, you'll get a data update at the end of the day, usually around 4:35 p.m. Eastern Time. Limited in some other aspects of the Power Options tools, but it's inexpensive. The most popular service, the 20-minute delayed at $60 per month, gives you access to all the tools, 15 to 20-minute delayed data, access to the picks of the day searches that Ernie put together for covered calls and naked puts, and getting your search results by email. In addition to the portfolio alerts by email as well in the delayed service. And then, of course, we do offer a backtesting service which you can upgrade. It's $40 more to get access to the historical suite of tools, and the real-time service, of course, is $120 per month as well. All right, so if you're looking for other education, remember you can go to our blog at any time, blog.poweropt.com. We already showed you and I sent you the link to the webinars page. Today's session will be posted there sometime tomorrow. I'll let you all know when, but it'll be posted under the Requested Topics tab in the webinars page. And of course, you can always check out our YouTube channel. Just go to YouTube and look up Power Options, all one word. You'll be able to see some of our videos as well. Okay. All right, so other than that, remember, if you do think of a question later on, you can send me an email at any time to support@poweropt.com or to support@radioactivetrading.com. Remember, we're also available during market hours. You can reach us here at 302-992-7971. All right, so ladies and gentlemen, take care. Thank you again. We'll see you online next week in one of our other live presentations. And again, I'll let you know when this archive video is ready to view. So good night, everyone. Have a happy weekend. We'll see you next trading week. Good night.